Whether you want to enjoy your retirement years, send a child to college, or just be financially independent, investing is a tool that can help you achieve your goals. While it can sound intimidating, investing doesn't have to be complicated. This set of 7 investing principles are the fundamentals you need for investing success. Principle number 1, establish a financial plan based on your goals. This begins with setting clear, realistic goals, then writing down a plan to get there. Investors who plan are more likely to take the steps necessary to achieve their financial goals and tend to have better savings habits than those who don't have a written plan. In fact, 65% of investors who have a written financial plan have an emergency fund compared to only 33% of those who don't. Additionally, those with a written plan are 3 times as likely to feel very confident about reaching their financial goal. Once you've made a financial plan, make sure you review it at least once a year and adjust it as your life circumstances change. Principle number 2, start saving and investing today. To grow wealth, you need time. Regularly contribute as much as you can afford, and don't worry about trying to time market highs and lows. To illustrate, let's say Maria and Anna each invested $3,000 every year on January 1st for 10 years, regardless of whether the market was up or down. Maria started contributing in January 2001 and stopped after 2010, but she kept the money invested through 2020. Anna, on the other hand, didn't start investing until 2011 and continued contributing through 2020. Even though they both invested a total of $30,000 and Maria hadn't added anything new to her account since 2010, she'd have ended 2020 with about $66,000 more because she was in the market longer. Even if you can't afford to contribute as much as the example, any contribution can help. And the sooner you start, the more time compounding has to work its magic. Think of investing like planting trees. The best time to start was years ago. The second best time is now. Principle number 3, build a diversified portfolio based on your tolerance for risk. Putting all your eggs in one basket is risky. Different types of investments carry different types of risk, so try to invest in a variety of asset classes like stocks, bonds, and cash. And within those asset classes, further diversify with different kinds of investments. Take a look at this chart. If you invested $100,000 at the beginning of 2000 in large company stocks, it would have grown to almost $425,000 by the end of 2020. But look at how volatile the journey was. If you'd invested in just fixed income assets like bonds or cash investments, it would have been a smoother ride, but you'd have earned less. Investing in a mix of stocks, bonds, and cash would have captured some of the growth of stocks with lower overall volatility. To decide the right mix of assets for you, consider your risk tolerance. How comfortable are you with temporary losses? It may depend in part on your time horizon or how far off your financial goal is. If retirement is 30+ years away, you may be able to take more risk. If it's more like 5 to 10 years away, you may want to take on less risk. Principle number 4, minimize fees and taxes. Markets are uncertain, but fees and taxes are guaranteed. Even if fees and taxes seem like small amounts, over time, they can eat away your returns. For example, if you had invested $3,000 in a hypothetical portfolio that tracked the S&P 500 index every year from 2001 through the end of 2020 without fees, you'd have almost $135,000. If you paid just a 1.5% fee each year, over the life of that portfolio, you'd pay more than $28,000 in fees. One way to limit fees is to choose investment funds with low expense ratios, which is a percentage of your investment that's paid to the fund provider each year. Just like fees, taxes can cut into returns as well. To minimize the impact of taxes, if your goal is retirement, consider contributing to tax-advantaged accounts like a 401k or an IRA before you contribute to taxable investment accounts. Principle number 5, protect against significant losses. Some losses are inevitable when investing, but you want to protect yourself from bigger losses that can be hard to bounce back from. This ties in with diversifying your portfolio. Having a mix of investments can help reduce big losses from riskier assets like stocks. You can see that in market downturns in the 2000s and 2020s. An all-stock portfolio got hit harder and took longer to recover than a diversified portfolio. Consider managing your risk with government bonds, cash, and other common defensive assets like precious metals. During market downturns in 2002 and 2008, defensive assets had positive returns while overall U.S. stocks contracted. Principle number 6, rebalance your portfolio regularly. Rebalancing means buying and selling assets to keep your portfolio in line with your risk tolerance. As assets grow, an allocation you set years ago can shift if left unattended. For example, if you invested 50-50 in stocks and bonds in 2009 and left it alone for 10 years, the stocks would have grown to be more than 70% of the portfolio, leaving the portfolio open to more potential risk. Discipline is important here. Rebalancing is one of those things you should do at regular intervals, like checking your credit report or changing your oil. Finally, principle number 7, ignore the noise. Markets fluctuate day to day, but it's often best to tune out the headlines and focus on your long-term goals. Historically, markets have increased over the long term. You'll go through some ups and some downs, even some big ones. But long-term investors who stuck to their plans have typically been rewarded. Whew, that was a lot. So let's sum up. Establish a financial plan. Start saving and investing today. Build a diversified portfolio. Minimize fees and taxes. Protect against significant losses. Rebalance your portfolio regularly, and ignore the noise. These 7 principles can guide you toward investing success.